very warm welcome to our viewers to the Outlook Money webinar series. This is a part of the investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund in association with Outlook Money magazine. Now, asset allocation is a key strategy, that can help investors achieve financial goals. In simple terms, it is a plan of action wherein you have to balance and distribute your investments between various asset classes such as equity, debt, gold, and similarly others. So to again sum it up, it basically helps fortify any portfolio from the ups and downs in various assets. So the idea is that when one asset suffers due to market movements or other vagaries, the other asset kind of steps into the portfolio to support the overall returns. So today we'll try and understand this concept and its utility in more detail. And we are in conversation with two financial experts who will shed light on this concept. So first, I would like to welcome and introduce Mr. K.S. Rao, who's Head of Investor Education and Distribution Development at Aditya Birla Sun Life AMC. So Mr. Rao has painstakingly worked in the area of financial literacy and investor education over several years, and he's at it consistently even now, and he's helped spread awareness in various demographies across geographies. The second expert joining us today is Mr. Amit Trivedi, who's an author, speaker, blogger, and trainer all rolled into one, and has more than 2 decades of experience in the capital markets. He's authored a number of books such as Riding the Roller Coaster and Money Wise Perspectives for Women, among several others actually. So welcome to this webinar series, gentlemen.
Thank you. Thank you so much, Lily. Indeed, it's an honor for us to be here, and we always look forward for these sessions.
Thank you. Thank you for being here. So let me start with you, Mr. Rao. Coming to asset allocation, which is our topic of discussion today, how can asset allocation kind of provide an edge to investors in terms of returns? So in other words, if I were to put it like that, what is the USP that it brings to the table when it comes to especially individual portfolios?
Thank you so much, Nidhi, for this question. And indeed, you have set that context very clearly, how this asset allocation can work. And asset allocation is nothing but it's a methodology to construct investment portfolio. And it's about diversifying the your assets into diversifying the investment into various asset classes. And how it provides an edge, if I can look at the edge is it minimizes the risk because you are spreading across, and it's it's also optimizing the return, of course. And we do not know which asset class in the beginning of the year. If I look at 2022 January, we are not very sure which asset class can do pretty well this year and which asset class will not. And
right.
This month when you're covered in your magazine, sit back and put the seat belts on. This is what exactly when you say next year when it comes, how it is. Analyzing that 2022 is easier, but predicting 2023 is very difficult. I think Lao Tzu, who mentions in the Art of War, it is like those who have knowledge don't predict, those who do predict do not have a knowledge. We can't predict. What we need to do is we need to prepare. While preparing, if you have a right balancing of these assets, that provides you the edge, because each of the asset class will behave very differently, and each of asset class is for a different purposes. For example, equity is for the wealth creation, debt is to provide the stability, or gold is to provide you hedge against the inflation. Each of them have a different narratives, and when you combine together, what exactly happens is your overall portfolio gives reasonably a good return, but it will give you a less volatile and more comfort to the investor. That's exactly an edge. But I put it in a lighter way. For me, this edge is EDGE, and that is your equity, your debt, your gold. Last E, it can be a international equity, or it could be a real estate of E of real estate. When you combine this, it will do. And I can give you one more analysis. I was just looking at the report for the last 1 decade. Each of these asset classes, this EDGE, have performed. Equity has given 2012 to 2022. I mean, it's a if I can look at Nifty 50 TRI, it has given little over 14.5% of CAGR. And 10-year benchmark of a GSEC has given 6.4 or 6.5, and the gold is around 4%, 3.8 to 4%. and where the real estate housing sector is given little over 10%. Means, no asset class is superior for a time, no asset class is inferior for some time. When you want to get the benefit of all these asset classes and you have a limited investments and you want to get that insulated against the volatility, that is an edge for you, the insulation. This is where a proper asset allocation can help. I feel.
Absolutely. Absolutely. So there have been years which have been very difficult for equities, as we have all seen. And in those years, I think the other assets kind of stepped in and helped investors' portfolios and even institutional investors for that matter. I think everybody who's investing it is important for them to kind of allocate between assets. In fact, some of the experts we've been talking to also, we spoke for the magazine also, have been saying that 2023 might be a year of where you should definitely look at multiple assets. So when we're talking of multiple assets, Mr. Trivedi, could you also throw light on what are the instruments that investors can look at to ensure proper asset allocation? Because we know the assets, but what are these instruments that we can look at?
This is a brilliant question, because a lot of times the discussion on asset allocation starts and ends at the asset category level. But then the investor is puzzled. So what? I mean, now what do I do? And that's why this question is absolutely appropriate. So first of all, in the equity category, you got multiple options to choose from. Take, for example, listed company stocks. One could also look at private equity. There is domestic equity, there is international equity. However, majority of investors, and I'm highlighting this word, majority of investors, would not have sufficient time, sufficient skills, sufficient liking, and sufficient size of a portfolio to be able to buy into these instruments themselves after doing a thorough research. They may not have the wherewithal to continue to hold on through the roller coaster ride of the markets. And in such cases, the ideal vehicle for majority of investors turns out to be a managed portfolio, where professional managers come, they, with their full-time job and their expertise, they manage these portfolios. And if these vehicles are highly regulated, even better. And that's where mutual funds come in. Now, this is as far as equity is concerned. When it comes to the other asset category, which is fixed income, there again, there are multiple options. Some of the options are relatively easy. For example, a bank deposit or a small savings scheme. But especially the small savings schemes, which are easy, you compromise on the liquidity. So be very careful about that aspect. If you're okay with compromising liquidity, that's okay. Go ahead with that. But otherwise, if you want a reasonably safe portfolio and liquidity and reasonably decent returns, then once again, mutual funds offer multiple options within that space. So these are fixed income mutual funds. Again, there are multiple varieties. So that's the other part. Gold, there are three broad choices that I look at. One is, and I'm not looking at physical gold in particular, because that becomes slightly difficult to hold, store, verify the quality, etc., etc. So that first option is ruled out. Now the other two options. The second option is sovereign gold bonds, and the third option is gold ETFs or gold mutual funds, where you are assured of the quality. Gold. So just a small point on sovereign gold bonds. Though the prices track the gold prices, these are government securities. So you're actually taking exposure on Government of India. So to that extent, they are rather hybrid between gold and fixed income. And the fourth option is real estate. Once again, physical real estate is an option, but physical real estate suffers from multiple issues, including liquidity, visibility. You can't sell part of the real estate. You have to sell the whole property. And the moment you sell the whole property, for whatever reason, so let's say I hold a flat worth 1 crore and I need 10 lakhs. I'll have to bear all the expenses on the additional 90 lakhs, which I have to sell also, whereas I only needed 10 lakhs. So that's the limitation. And of course, liquidity is poor. Very often you've seen spells where for months one is unable to sell off the property. equity and debt and even gold, the requirements can be fulfilled through mutual funds. And for real estate, REIT could be a better choice.
Right, Mr. Trivedi, you have, highlighted a very important point, which is about liquidity and how important it is for financial portfolios, especially if you're looking at your goals, your financial planning. And real estate, of course, like you mentioned, can be a very illiquid asset, very high cost asset. It might not help you in emergencies or even for short-term goals. It might be a difficult asset to handle as such. So, linking this whole issue of liquidity and asset allocation and financial planning. So, Mr. Rao, I'll put this question to you. How can asset allocation play a role in helping investors meet their financial goals efficiently without kind of going through such liquidity crunches and other problems?
Fabulous. Fabulous for wonderful question and the way you linked it. It's I really appreciate it. And thanks, Amit, for bringing the liquidity space and the return space and the multi-asset on how it performs. And when it comes to individual investor, I mean, I have a multiple goals and there is an combination of multiple assets. How do I do what I need to do it? I mean, what is my risk return takeoff? And predominantly we can't take each and every goal, but we will put it short-term goal, medium-term goal, and long-term goal. And short-term goal, predominantly what you need to look at is your liquidity should be higher for you. At the same time, you can't afford to forego whatever the little better return what you can get other than the savings bank or fixed deposit returns, where you can look at. Then in such case, your asset allocation could be what kind of asset allocation you can look at. If I have my 1 year money, it could be 3 months what I need and 6 months what I need, roughly what I can anticipate and how I can put it. Means predominantly I look at liquidity is the criteria and I put my money. That's an asset class which I'll allocate is multiple. Within the asset class, multiple products of liquid funds I can put it. That's the first part. When it comes to the medium term, I mean, probably a 2 years to 5 years span, and I have ability that I may not need that kind of liquidity, but I need liquidity reasonably available in case of the need, and rather it need to give a moderate return to me so that I don't want to take extra risk. I should not have a capital loss. Here, either I can get into balanced advantage fund category, or I can get into partly debt and partly a little bit of equity to it as an asset class where I can have a portfolio I can construct. But when it comes to a very long term, and I can't put one asset class again, it's a equity as one asset class, and within the equity, I have a multiple various ways I can look at. My long-term goal, if it is my child education and globally I'm looking at, probably part of international equity I'm handling. Or my long-term goal could be my retirement plan. Then your long-term goal can have a balanced kind of assets. And I mean, at retirement plans, you can't take the shock, though equity can give a better return. But sometimes it is like a kind of return. I mean, we can always look at equity in Japan. I mean, for 2 decades, it has not given anything, right? And you can't take that class. Then how you put it, your asset allocation will be a little different. Or you want to create purely a wealth creation is a long-term goal. Probably I'll take little more risk and I can put into various types of equities. Then I can look at. In the meanwhile, I mean, multi-assets again play a vital role. And earlier, when Amit was talking about some of these constructed portfolios can also play a role when you have a financial goals. You don't need to rebalance and you don't need to worry how the market behaves. Then you can come back to those portfolios which are which is aligned with asset allocation. Then you can invest in those funds.
Mm-hmm. Right. So, Mr. Rao, you've highlighted that how different tenures might need investors to go for different asset allocations. So that is one. That is of course your individual circumstance or the tenure of your goals. The other thing that we see among investors, especially because equity kind of comprises a large part of any portfolio, even when it is allocated properly, but when markets are volatile, so a lot of people who understand asset allocation, they quickly go and maybe sell some of their some of the stocks or mutual funds and book their profits. But with the market the way it is, like for example, a month ago it touched 63, and now again it's volatile still, and the whole year it's been volatile. So, Mr. Trivedi, I'll put this question to you. Construct one's asset allocation strategy when the markets are volatile, in such volatile times, and equity being a large part of the allocation strategy?
Okay, so let me just turn this question around and say that it's how should one construct a portfolio when markets are volatile, or you need to plan your asset allocation properly because the markets are going to be volatile. Okay, so actually, the underlying theme is that Rao sir highlighted this beautiful point when he shared the numbers of 10-year returns of all the four broad asset categories. Now, if you look at that, then over a long term, we expect the asset prices to move up. Okay, that's the starting point. Because if I don't expect an asset to move up over a long period of time, then I'll not buy it anyway. I mean, if I'm looking at a fall in the price. Okay, so that's the primary assumption. But historical evidence suggests that all the movements are non-linear, which means there are ups and downs, there are positive returns and negative returns, there are high returns and low returns. So there are periods of that in the interim, whereas a 10-year return from equity was 14%. We also saw in 2020 that the markets fell by 40%, 40, in a span of a couple of months. So it's bound to happen. Now, the beauty of the difference in the asset categories is that while the long-term returns are positive, the short-term prices go up and down, but that up and down movement does not happen together in all the asset categories. And that is what we call the benefit of diversification. What we typically recommend is that you start with an asset allocation based on three things. One, how much is the need to take risk? Now, the need to take risk is a function of how much is the return required. Second is how much is your ability to take risk? And this ability is about financial situation, how far the goals are, how big the goals are, etc., etc. And third is the willingness, which is the psychology of the investor, whether you can psychologically handle that volatility, that risk or not. You do an assessment, and there are various tools available to do this assessment. There are financial experts like mutual fund distributors or registered investment advisors who can help investors with doing this analysis of need, ability, and willingness. And based on that, you arrive at an asset allocation. Once you've done that, that asset allocation has to be tracked in terms of percentage of money allotted to a particular asset. So take, for example, a simple case where somebody's profile suggests that 50% of the money should be in equity and 50% in fixed income. And because the willingness and ability is low, you can't exceed 50% in equity because equity is a risky asset. And then periodically when you see, because equities may move up and fixed income may not, or equity may move down and fixed income may move up, because of that, the 50-50 will become imbalanced. Whenever that happens, you rebalance back to 50-50. So typically what would happen, you'll buy equity when it is low, you'll sell equity when it is high. Once that is done, then overall the portfolio's movement would become smoother, while the long-term average, weighted average return would remain intact more or less. And that's how you really look at the portfolio. It requires a lot of discipline, and the discipline is, like the child in that candy store. You see so much candy around, and you don't have to go to any of the candies. You stay focused on, what you are supposed to do. So an investor would see a lot of temptations around. Somebody would come and say, this asset is doing so well, why don't you put money in this? And whereas an advisor may be recommending, or a mutual fund distributor may be recommending, what is doing well, pare down the exposure and get into something that's not doing well. It requires immense amount of discipline, and that's where a professional help would be better. So basically the taming volatility is all about asset allocation, understanding the principles and rebalancing back to the original allocation.
Right. So in the same vein, I would ask you, Mr. Rao, that, volatile times, of course, like Mr. Trivedi highlighted, that it depends on your portfolio, on your needs, on how much you allocate and when do you do it. So according to you, what is the ideal time one should look for asset allocation, as in because again I'll come to a similar question that I put to Mr. Trivedi also, that basically, when markets are volatile, you feel, oh, now the markets are up, let me book some profits. So maybe the last time you did that was only 3-4 months ago. And so what is how do retail investors kind of work out a periodic kind of review, or put that into their discipline, and what is that ideal time frame according to you?
Yeah, thanks, Nidhi. I mean, after listening to Amit, I was always looking at when for a common investor, what he or she can do. I mean, it is like, sometimes allocation is fantastic. Allocation definitely a fantastic tool. You can ensure that you are optimizing your returns. But when you look at various ways, we call about various ways of asset allocation. It's a strategic allocation, like how we can simplify. And to simplify, let us redraw entire journey. What is your investment philosophy statement or purpose statement? If I'm investing in a particular goal, then I can adapt one way. If I'm not broadly, if I have my financial planner, as earlier Amit was talking about an expert, then I have my quarterly review, off yearly review, and yearly review. And rebalance can happen sometimes yearly, sometimes it's a need based. My goals are, I accomplish my goals, and sometimes it could be a situational, some drastic things have happened, it is better I can foolproof my portfolio. I can't wait, I'm sure it's going to crash this assets class. I mean, things may happen, kind of it, when you have such a certain information. Keeping this aside, how one somebody can simplify is lay investor, 60 to 70% of investors, for them it's like, investing is easy and staying back there, and they don't want to do this because they do not have time, or at that time they may not understand the whole logistics and game of this asset allocation. For such people, you have a wonderful products created at mutual funds. One could be your balanced advantage funds, where, and second is the balanced fund, diversified, and where fund manager will take a call. I mean, you great an advantages, whichever the asset class is getting rebalancing, fund manager will be doing that part of it. And second, for you, the tax liability will be coming drastically down because you are not impacting in each of this asset class. For example, if I am doing rebalancing on myself, if my debt fund, if I have not completed 3 years, I end up paying little more capital gains. And in the same way, the equity, if I have not completed 1 year, I have a short-term capital gains versus long-term capital gains, the challenge will come. Better is stick to your balanced advantage funds. And right across, you have also, like, I was reading your magazine of this month. It's well covered magazine. Congratulations to you. And, one of those, a couple of articles which I was looking at, apart from what you wrote about editorial, tightening the seat belt, and it's a multi-assets is another way to look at, it's a, when I look at no asset class can have a priority over other, I can put my money in multi-assets. And even this multi-asset play, investor can play very comfortably through SIP route. Means you are getting an advantage of asset allocation. Second, you are also looking at not looking at a market timings, and you are putting at various periods of time. Means you are more or less foolproof that you are not going to lose out in the longer run, and you fairly get better return than the average. And rebalancing you don't need to do, it happens automatically. SIP makes a auto investment, and multi-asset will make a auto rebalancing. That's that's a better way to look at it.
And so, do you think there are other funds also, like balanced advantage funds? Of course, give automatic asset allocation. They do it for you on your behalf. But maybe investors can also go with specific equity funds or debt funds, or even gold focused funds. So all of this kind of also makes it, sometimes it makes it confusing for the retail investor on which strategy to follow, where to look for, and how to kind of strike that balance, which is at the heart of asset allocation. So, Mr. Trivedi, if I were to ask you, so when it comes to so much confusion and so much choice in the market, there is a lot of choice in the market now. So how should individuals deal asset allocation? As in, what I mean to ask is whether they should do it themselves. Should it be a DIY exercise, or should they go to experts to kind of ensure that they are on proper track?
Nidhi, it's a sort of eternal debate whether DIY works or what does one need professional help. And in the proliferation of this internet-based information overload, you see many areas where a lot of people just simply go to any YouTube channel or Twitter or whatever, and then they try and implement those things without realizing. Because otherwise the DIY and I'm borrowing from Rao sir, or rather learning from Rao sir in expanding the acronyms. So that DIY, which is popularly called do it yourself, often becomes damage it yourself. And at worst, it becomes destroy it yourself. Let's not get into that. Let's not get into that. And I'm not saying that everybody should not be doing it. There are some people who are capable of doing it. However, where do we need help? And there are two areas where we need help. One, the knowledge of the alternatives available. And a detailed knowledge, reasonably detailed knowledge. You were explaining in the question also that there are so many choices. Now, how do I choose from? So do I have that requisite knowledge is one part. And number two, do I have the emotional balance and the discipline to do it? It's like, John Bogle of Vanguard Mutual Fund used to say, press on regardless.
Right.
Do you have that wherewithal to press on regardless? And that regardless is what is going on around, the noise that you see or hear, the results, short-term results in particular. Do you have it or not? And that's where you need a second opinion, reinforcement, reassurance, and that's where an expert can come in and play that balancer or sort of sounding board. Now, first is the technical expertise, where you understand the options available and how to use those options. And second is the emotional intelligence or emotional balance. And a combination of these two is where an advisor can play, or a mutual fund distributor can play a huge, huge, huge role in the life of the client. It is possible technically and theoretically to do it yourself. But can somebody really do it? That's a big question. In my experience, I've generally seen it doesn't work this way. You've got to take professional help. Number two, while talking about professional help, it's not about just taking help, it's about taking professional help. And that professional help is a combination of somebody going to an expert who has two things, and both are required. One is the competence or the ability, and second would be the integrity or character, and both are required. Now, the mistake that a lot of people tend to make, and I'm not saying it's a fault, it's the tendency. I'm not an expert in a field, so I need help. So once I realized that, but how do I evaluate the expertise of an expert when I'm a novice myself? So if I can't evaluate the expertise, what do? I look for the second trait, which is the character or integrity. And who else than my friends, family members, my office colleagues? So we tend to take advice from people who are around us, assuming that they also have the requisite expertise. And often that also turns out to be harmful. So go to the expert who's competent and has good character or integrity. But then the third angle to that expert is the competence. A lot of times competence is not fungible. I mean, if I have a neurological problem, I can't go to a urologist.
Right.
It's that simple. I mean, both are branches of medicine. Within financial services, within investment landscape, there are multiple experts, and you've got to go to the right expert. So these are basic things. So right from do it yourself, I think going to the right expert is the real journey that one has to do. Yeah, one may have questions as to how do I evaluate? Well, keep going back to your requirement, stay focused on your requirement and ask those questions. How does something work? Whatever you are seeing, how does it work? And what are the possibilities that it may not work? And if it doesn't work, what is the downside for me? Keep asking those questions and let the advisor, professional, mutual fund distributor engage into a discussion of talking about downside and the protection against downside that one has built. That's how I'll put it.
Yeah. So as Mr. Trivedi highlighted, it is, not just if you are a DIY investor, then of course you have to ensure that you have the proper know-how and even time. It's not just enough to have the know-how, but even the time to be able to do it yourself. And otherwise go to experts who can help you, who are called experts because they know the area very well. And within that community also, you have to be a little careful about who you go to and what you kind of expect from the financial advisor. And of course, it comes back to your own requirements, your own goals, etc. And that will really help you allocate properly and give an edge to your returns and portfolio, like the topic of discussion is today. So thank you so much, gentlemen, for shedding light on the nuances of asset allocation and helping our audience to kind of understand this concept in detail. And thanks a lot, and good day to you guys.
Yeah, thank you so much, Nidhi. Indeed, it was very interesting conversation. Thanks with Amit too, and I wish entire Outlook team for this support to taking this financial literacy across, and also wish audience Merry Christmas and Happy New Year, because our next webinar will be coming for the next year.
Yeah.
And last but not the least is have an allocation. For me, it is an idea, that is IDEA, ideal debt equity allocation, to accomplish your goals. And thank you so much, and wishing you all the good luck.
Absolutely. So the edge of asset allocation is equity, debt, and gold, like Mr. Rao put it in the beginning. And good day to our viewers.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.